The Canadian dollar is inching back above 91 cents U.S. after dipping below that mark earlier this morning. It's at the lowest levels since 2009. Yesterday, Scotiabank economist Derek Holt told us he thinks the loonie could fall to around 87 cents later this year. Let's head to London now to get the international view with Ashraf Laidi, Chief Global Strategist at Citi Index. How far can the loonie go this year, Ashraf?
Well, a lot of people used to say that this would be the year, this might be the year where the loonie would be dragged by the dollar, let's say, where the dollar would regain above 105, 107, or fall below 90, and on the other way. But I really think this is the first year where the divergence of the rhetoric from the BOC is really on the dovish side, relative, and the key here is the key word would be the relative factor to the Bank of England, which are less dovish. The Federal Reserve could be expected to taper again, and the ECB may be talking on the dovish side, but not really do anything about it. But going back to the Canada side, if you look at the labor reports, while the unemployment rate in the U.S. continues to drop, we're seeing the unemployment rate in the north of the border inching higher. The participation rate in Canada has more downside than that of the U.S. And last but not least is something that the Carney BOC used to look at, and now the Polos BOC is looking at, which is basically the ratio of personal debt to GDP, which continues to push higher around 97%, but house prices are starting to pull lower.
We have the central banker here in this country seems to be in a bit of a difficult position. You talk about those debt levels. There's been all kinds of hand-wringing about mortgage levels and the overheating Canadian market. At the same time, you have less dovish, as you call it, positions by the Fed or the Bank of England, which people are suggesting we're going to see more dovishness tomorrow from Mr. Polo. So how can he be a dove and have all those debt worries?
That's a very good point, and that was the last point of the difficulties and the challenges by Mark Carney. He was being dovish by reducing the Bank of Canada outlook, but without saying that they're going to cut rates. And he actually basically said that we probably need to raise rates. Then the BOC start to take away that wording. The central banks have many instruments to balance between the necessary hawkishness and probably the dovishness. But here is one thing: the currency factor is easing, the currency is falling, but like the head of the BOC basically hinted, Mr. Polos, who comes from an exporting lobby background, let's not forget that, he basically did not waste time to remind that he is at pains of trying to figure out why exporters are not being boosted by the decline in the loonie. So the BOC is keeping the door open for further weakness by doing what? By downgrading or being more cautious in its outlook towards the GDP. That is a point that will never be missed by the currency traders. So the BOC tomorrow is not only it's not expected to cut rates, but it won't have to see further weakness in the loonie. So they won't have to cut rates, something that may further provoke housing, or housing debt, but we could see a further weakness in the loonie. And for a currency trader, looking at somewhat a challenging lens for 2014, one of probably the clearest calls would be further loonie weakness against the British pound, against the New Zealand dollar. That's a central bank that is actually expected to, believe it or not, raise rates at the end of the year. And as for the dollar CAD, the US dollar versus the CAD, that is a pair that usually pushes up when stocks go down. So when risk appetite is on the wane, the Canadian dollar is one of the currencies that is mostly inverse related to the stock markets. So once we get to this much anticipated pullback in stocks, whether it's 5% or 7%, that could further aid the story gradually towards 112, and that's why we're looking at even 116.
So, and in fact, the other way for us, obviously, going down to that at 115, it's 87 cents. So tomorrow, let's be clear, you're not expecting a rate cut. You might not even be expecting a rate cut this year, but Mr. Poulos is going to continue to talk down the dollar.
Yes, and exactly, and because of the tightrope that you referred to, because of the housing aspect, maybe there will not be needing to cut rates. But you know, for the people who are watching this show, you know, what is important for you, whether the currency is going up or down, or what they're going to say. And I think that whether they, so regardless of what the central bank does, we do think that it's going to be, that the market is going to drop, that the Canadian dollar is going to weaken, and then there is, and if the BOC does not put across its point very clear, then 2 days later there is the the policy report or the press conference that is by the BOC that usually comes after the announcement, and there will be more detail regarding the numbers and the outlook by the BOC. And again, you know, we're here in England. I mean, you guys know this stuff more than we here know about Canada, but we don't need to wait for the BOC to speak. There is the finance minister from Canada who also has some statements that are not so positive about the Canadian dollar, whether interpreted on one way or the other. And so there is much of the clarity there in terms of weakness in the CAD.
And Ashraf, just before we leave you, the bottom line, you're not buying the Canadian dollar here at all. You're stepping aside.
No. Maybe if anybody wants to buy the Canadian dollar, maybe would probably look at the dips in the Canadian versus the Japanese yen after the Japanese yen makes an anticipated rebound, but that's really about it.
That is a different trade for the guy who buys his bread in Canadian dollars. Ashraf, thanks for joining us this morning.
Thank you.
It's Ashraf Laidi. He joined us from London. He's the Chief Global Strategist at City Index.